Here's the truth. Most people lose money in the stock market not because they're unlucky, but because they don't know how to read the chart. That's exactly what we're fixing today. You open a candlestick chart, but then the big questions hit. When should I buy in? When should I sell? Without the right tools, you're basically sailing without a compass. If you want to consistently make money in the market, you need two things. Learn how to read candlestick charts and learn how to use MACD. MACD stands for Moving Average Convergence Divergence. It's one of the most widely used technical indicators in the world. Some traders even call it the king of indicators. So what is it? MACD is built on moving averages. It takes the closing price of a stock, runs some math behind the scenes, and helps you predict trends and spot potential, buy or sell signals. It's made up of 3 parts, 2 lines, and a histogram. The blue line is called DIF and reflects the change in price over time, also known as the fast line. The red line is called DEA. It is the average of the DIF and is relatively smoother, hence the name, slow line. The formulas are simple. DIF equals 12th day moving average, 26-day moving average. DEA equals 9-day moving average of DIF. In the middle, you've got the bars, the histogram. Green bars above 0, red bars below 0. They show the distance between the 2 lines. The further apart the lines, the bigger the bars. Different platforms might use different colors, but the concept is always the same. Now, how do we actually use MACD? There are 3 main ways. 1. Look at the position of the 2 lines. If both lines are above the 0 line, the stock is trending up. That's a good time to buy. If both are below 0, the stock is trending down. In that case, the safest move is to stay out or short the stock. 2. Watch for crossovers. When the fast line crosses above the slow line, that's a buy. Signal traders call it a golden cross. When the fast line crosses below the slow line, that's a sell signal, known as a death cross. 3. Read the histogram. Think of it like traffic lights. Green bars above 0 equals bullish trend. Time to buy. Red bars below 0 equals bearish trend. Time to sell. Let's do this practical example. We can see in this chart that during the market's uptrend, the MACD formed a golden cross. The fast line and the slow line both broke above the 0 axis, signaling a strong bullish trend, and the market surged all the way up. With the golden cross in place, the index shot up sharply. But when the MACD flashed a death cross, the index started to fall. And here's the thing, even if you didn't look at any other indicators, just following MACD alone could have helped you sidestep that crash and catch the huge V-shaped rebound. So yeah, MACD can definitely help you avoid major downturns and catch those big rallies. But here's the thing, it's not a flawless tool. It's just one indicator that helps you confirm the trend, not something you should rely on alone. Because MACD is based on moving averages, the signals always lag. In a sharp V-shaped rebound, by the time MACD tells you to buy, the price has already taken off. And when markets turn down, MACD often warns you, late you've already lost some profits. That's why I never rely on MACD alone. I use it as confirmation, not as my main decision tool. MACD is great for spotting long-term trends. Golden crosses and death crosses work well for swing and position trading. But for short-term moves, it's too slow. So here's the bottom line. Short-term traders should use faster indicators. Long-term investors can lean on MACD. And when you combine it with other tools support and resistance, fundamentals will have a much higher win rate. Alright, that's it for today's video. If you learned something new, hit that like button. And if you enjoy content like this, make sure to subscribe so you don't miss the next video. I'll teach you how to read other indicators in the next video. See you in next video, and happy trading!